Vetri Subramaniam is joining us now. He's Chief Investment Officer at UTI Asset Management Company. Vetri, good morning. Great to have you with us here. Thank you very much for your time. Will we look through this persistent rise in oil prices? Many believe the price, it may not sustain. I mean, it's too much and the fundamentals don't support it, but that's besides the point. No one knows. If oil stays around closer to 100 than it's been in a while, what is the impact in terms of trade? We're a big importer and consequently on markets as well as you see it.
I think, Prashant, it's never a single correlation factor in terms of higher oil prices either being positive or negative for the Indian equity markets. We always have to see it in the context of what's the growth looking like and how does that compare to the pressure feeding through from crude oil prices. I think at this point of time, while the rise in crude could certainly create some complications on the fiscal side as well as the trade deficit, I don't see it significantly derailing, at least at the current prices, $90-$95. I don't see it derailing the trajectory for the Indian economy over the short to medium term. And I think we need to also keep in mind that one of the reasons oil is doing so well is that the US economy is actually proving to be much stronger than what anybody anticipated. And on the other side, for whatever set of reasons, the OPEC plus set of countries are actually sort of doing, at least from a market price point of view, doing a pretty good job of keeping the supplies tight. So things are quite evenly balanced over there, but I would not drive a one-on-one correlation between what oil prices are doing and what Indian equities will do at this point.
Okay, by the way, after the initial gap down opening, it's kind of settled. So the selling pressure for now at least has gotten arrested. On the Nifty as well, we are back above the 20,000 mark. So a little bit of, sanity has prevailed. I think the low of the day was 19,968. So from there, the Nifty has pulled back a tad bit. So let's see how things go for the rest of the day. Early hours yet. Vetri, hi, good morning and thanks for joining in. After a very long time, we're seeing a big comeback in the PSU banking space. But as we know, PSU banks have not been the best, segment for long-term investors to get into. It's hardly created wealth. Do you think this time around things could be different?
I think, again, we've got to be a bit selective over here. The way we look at bank stocks is that you have to be able to create at least a, 1% sort of return on assets to get to a point where you can create some shareholder value. If you're not able to create a 1% ROA, then, that business model is in trouble in the medium to longer term. And the other issue with not every PSU bank, but many of them in the past has been that they haven't been able to navigate credit cycles very well. So maybe the market's doing a bit of a catch-up trade in terms of the fact that these banks as well, coming through COVID have managed to clean up their books quite well. This is visible in aggregate sector data. But to my mind, the bigger challenge really is that when I look at the way the data is coming in terms of incremental market share, both on deposits and on credit, then I think, there's a set of about 5 to 6 banks, both private and public, which are really starting to take in 2/3 to 70% of all deposit and credit market share. So I think the bigger picture, if I look out over 4 to 5 years, is really the domination that's coming through of those few institutions rather than the PSUs, which may have done the best part of their catch-up trade.
Hi, Vetri. Good morning. Vetri, when we spoke the last time around, you said that mid and small cap party was getting a little bit too exciting for your comfort and you would rather take some money off the table and you would rather lean towards large caps. Do you continue to hold on to that thought? Because that seems to be the consensus view right now. And also in terms of sectors that you liked, Pharma was one sector that you said, well, it has some kind of cushion and you believe prospects are looking up. So do you stick to that?
You've clearly got a very good memory there. Well, I would say, small and mid caps have really been a big surprise for me. Honestly, even at the start of this year, I would have not voted for such strong outperformance for mid and small caps relative to large caps. So it's come as a massive surprise, the extent to which mid and smalls have actually outperformed large caps. But, eventually, my train of thought and thought process is always linked to the fact that starting valuations reflect expectations, and therefore they tend to be a weight on the forward returns going ahead. And when I look at it from that point of view, where I find the burden of expectations the highest today is in mid and small cap space, where on a relative basis to large cap is quite pricey. And what we do know is that whenever the economy goes through some kind of pangs, and you'll never know what sort of pangs and when they will come about, it's the smaller companies which struggle to sort of navigate those environments. So when I will look at this combination, I would stick to saying large caps is where we have comfort. We don't have much comfort from a valuation point of view in mid and small caps. And finally, from a sector point of view, I'd still stick to saying pharma, healthcare, unloved but in reasonable valuation territory, and sort of mid-cycle, meaning valuations are no longer cheap, but the cycle is looking reasonably positive, is really in the banking and automobile space.
Okay. Vetri, your thoughts on HDFC Bank? I mean, if you want to weigh in there. We've seen the numbers in the merged entity, so perhaps slightly negative at the margin. But if you believe that maybe there's more comfort in large caps, financials are 40% of the nifty weight, and banks is where there is, relative to history, some valuation headroom as well. What's your view on HDFC Bank from here?
Sure. As you know, we don't really discuss individual stocks, but without any doubt, it's a significantly large holding in some of the strategies that we run. We haven't seen anything, and the market may have to readjust, or analysts are having to readjust their models because the bank just put out what the numbers would look like post-merger. So the analysts are having to readjust their models. But I don't think that readjustment of models has a longer-term implications of what we have believed would eventually be the kind of growth outcomes and the ROA outcomes the bank would deliver. So not much of those disclosures they made this weekend would really change our thought process.
You spoke about autos, and I want to ask you because, we are having a conversation with one of the auto ancillary companies in a bit, Uno Minda, and talking about their growing, electric vehicle presence. So is this a space where now only the EV guys are going to generate further alpha from here? Because that's the way it appears, right? With the kind of performance that we've seen, whether it's Tata Motors, M&M, even some of these companies in the broader markets. Is that the main focus area now?
Sure. Actually, no. I would say if you look at automobiles, one of the things which we always found very striking is that the peak year for automobile sales was actually financial year 2019. And it is only in the current year that areas like, four-wheelers are actually delivering as an industry volumes which are higher than 2019. So it's been a very long, cold winter for the automobile industry, variety of factors which have subdued demand, plus they've had to deal with supply side issues. But I think what you're seeing now is a cyclical recovery, and that's the story that we would continue to back in terms of the fact that there are very few product segments in India where you would expect to see 5 years down the road demand actually being lower than where it was in 2019. And auto is one of them. Two-wheeler volumes still running lower than where they were in financial year 2019. So it's really a catch-up cyclical trade. The point that you made about EV, I think that's a question of who will be the winners during this change in technology within the automobile sector. Some companies could come out stronger simply because they've sort of been ahead of the curve in terms of product development, or they're not exposed to segments of the automobile where really there is no alternative because they're very closely wedded to the ICE engine. So I think that's a technology change, and we'll have to see which companies are able to transition better. One final point, I think the biggest challenge in automobiles when I look out more structurally is really the issue that they're going to have to defend their core business and invest for the EV business. So, the outcome in terms of who emerges victorious or who emerges on the back foot would be very different. And that's something that we'll have to keep an eye out for.
All right. In fact, we're going to take this discussion forward. So thank you for, setting the tone for this interview. Vetri, always great speaking with you. Thanks for joining us on CNBC TV 18.